What is leverage? Leverage allows you to gain a large exposure to a market for a relatively small initial deposit. This means that if a market moves in your favor, your net returns could be much greater than in traditional trading and your profit is magnified. However, if a market moves against you, your losses can also exceed your initial deposit, so it's important to understand how to manage your level of risk when trading. Let's use a few examples to understand the way leverage works. Example 1. Our first trader wants to open a trade on EURUSD worth 0.1 lots. The contract value is therefore 10,000 euros and leverage is 200 to 1 or 0.5%. This means that the investor needs 0.5% of 10,000 euros, which is 50 euros, at a deposit to open their position. Example 2. Our second trader wants to buy a contract for Standard & Poor's 500 with a multiplier of 50. For the sake of this example, the price of the Standard & Poor's 500, let's say, is 2,000. To open a position without leverage, the investor would need 2,000 times 50, $100,000 in their account. If the leverage is 100 to 1, the trader only needs 1% of that to open a position. So with just $1,000 as an initial deposit, they can gain exposure equivalent to $100,000 in the Standard & Poor's 500. So what are the benefits of leverage? Leverage enables you to get the most out of your investment funds by being able to trade large positions and committing just a fraction of the trade value as an initial deposit. You can also take much larger positions than you would otherwise be able to with physical purchases. Your returns as a proportion of your initial investment are much greater. You can make your capital go further by investing in a range of different assets. Now, what are the risks of leverage? Just like your gains are magnified, so are your potential losses. You could lose more than your initial deposit if you don't manage your risk carefully. If you have a basic account, you can reduce your overall risk by using a guaranteed stop loss where available, which can limit potential losses to a specific amount, or you can simply reduce the size of your position. Margin levels and initial deposit requirements. Your margin level is the deposit required to maintain each open trade on your account. To open and maintain your trade, you must have sufficient trading resources to cover the margin requirement at all times. Free margin represents the amount of capital you have remaining to place new trades or cover any negative price moves in your open trades. At XTB, we operate a margin level of 30%. The limit level is calculated by dividing your equity by the required margin and multiplying by 100%. Within our trading platforms, you'll find an indicator called the margin level. When this indicator falls below the level of 30%, your open position with the biggest loss will be automatically closed as an inbuilt safety mechanism by us to help you from incurring even greater losses. To avoid being closed out of your position by a margin call, you'll need to ensure your margin level is always greater than 30% by depositing more funds.